Okay, so thanks a lot everyone for joining us on today's webinar. It's going to take 30 minutes and the goal is to showcase our integration with MantaRisk's risk engine and some questions and advanced analytics it allows you to do and questions to answer. So my name is Dennis Agander. I'm a director with WealthArc. For those who don't know, WealthArc specializes on two core topics. One is consolidating and allowing for a strong data foundation in a multi-custodian setup. And once that data foundation is secured, we offer a portfolio management system on top. Our main clients are multi-family offices and independent wealth managers. With me today is Cedric from MantaRisk. Maybe Cedric, you can also quickly introduce yourself.
Yeah, hi, I'm Cedric from MantaRisk, CEO. And with me today, there is also Raphael Lamont, who is my co-founder. MantaRisk is a company that started 4.5 years ago. And basically, we provide institutional grade analytics to family offices, multifamily offices, and also private banks.
Perfect. Thank you so much for being with us today. So let's go right into it. For that purpose, I will share my screen. I will just give it maybe 5 seconds to load. So I'm sure you can all see my screens. Now, what we are seeing here is the WealthArc manager dashboard from our portfolio management system. You can see it's opened in my dashboard. Typically, this is the manager view. So this will allow me, a high-level view across all my portfolios, across several custodians. Today, we, however, want to prepare and discuss portfolio of our client, David Smith. What I can see here when I call up his name, there's several portfolios. So let's maybe quickly go in here. And it tells me we have a consolidation here. So there's several different portfolios that are connected to this consolidated view. Today, we would like to discuss his UBS portfolio, which is coming right up. When I click here on the dashboard, I get some additional high-level information on overall performance, the assets that are booked, and maybe just to quickly showcase you how the portfolio is structured. We can see it here. This is obviously just a demo portfolio, but it will serve the purpose for today. So what we can see here, there are some cash deposits. We have some accounts. There is some fixed income products, but mostly, and when I say mostly, I mean 73.46% of his portfolio is directly invested in equities. So let's maybe think of a question that could come up by the client or a likely scenario. When we look over to the Gulf region, we still see the whole situation around Hormuz is unresolved. We've recently seen the WTI for crude oil drop below $100 again, but the real economical data doesn't support this. There's a lot of uncertainty. So what if the client wants to understand what happens if the oil price goes back up to $120? That would mean an increase of 20%. So in that case, I could now hover over. And as you can see, there's several different modules here. And when we go right to the right here, we see there is an integration with MantaRisk Analytics. And this is now where I hand over to Cedric. And Cedric, can you help me out to figure out what would happen if the oil price goes up for 20%?
Yeah, absolutely. I think it's, I guess I'm going to start with saying that this is basically the main use case for our tool. Client comes in, maybe he's consulted ChatGPT. We see that more and more these days. Goes to his portfolio managers and says, hey, why this? Why that? And by the way, have you done your work properly? And ChatGPT says this or that. And so what we found out, is that wealth managers are using our tool as a mechanism to convey the fact that, yes, we have done the math. We have looked at the scenario where oil goes up by 20%, as you wanted here. And the conversation with the end user is, or the end client, I should say, moves away from emotions to, oh, okay, my wealth manager knows what he's doing. And that's kind of the power of analytics. Obviously, you can try and convince wealth manager that it's also the best way to manage portfolio. But the main use case is actually to reassure the client that, the math have been done.
And naturally, that's what they would expect, right?
And indeed, yeah, this is what you're in right of expecting. But 95% of the independent asset manager, even like we've seen firm with 4 billion AUM, do not use analytics today. Now, one of the reasons is obviously, if you go and fetch your analytics from Bloomberg, it's going to be prohibitively expensive. But like you said, with WealthArc, with us, there are solutions out there, and that makes a huge difference. So, anyways, let's just go to the scenario. So this is David's portfolio, and we have a risk module here, and we're going to create a hypothetical scenario. Okay, so we're going to go oil up. Now we have a number of factors that we can use to build those scenarios, and those scenarios can be composite scenarios. So here we said oil, so oil is a commodity. So let's just find oil in there. There we go, plus 20%. Okay, we can spice up the scenario later if you want, but for now we just do one factor, oil plus 20%. What will be the impact on my scenario? So let's just run it, and it's all done in real time, by the way. Discovery of instruments. You don't need to preload instruments. That's quite how do you say that? A differentiating factor from our competitors. So here, with oil going up, basically we have an impact on Amazon and Google, which are correlated to this commodity on a number of areas. So it'll be energy price, it'll be ability of customers to spend on discretionary goods, because Amazon sells discretionary goods and Google sell ads for these discretionary goods. So there will be a number of impacts. So these are in your portfolio, from a correlation standpoint, you've got quite a number, like maybe 4 of your stocks here that constitute probably 80% of your loss, right?
Uh-huh. So just quickly, up there I see the figure current. So that would be the performance as per current market conditions.
Yeah, so this is expected returns. So maybe, Raphael, you can explain a little bit on how expected returns are calculated in our platform.
So we have various ways of calculating expected returns, but in this case, we use a type of Markowitz based on risk factors, expected returns, because often it is easier to have a picture of expected returns on risk factors on large indices than on individual stocks.
So this is our projection based on this factor correlation of your expected returns in the next year. That's how we calculate
Understood.
it.
Thank you.
Good. So yeah, I guess that's where we are. What we could do as well is spice it up a little bit, or try and address these issues. What do you want to do, Dennis?
Yes, maybe just, I forgot to say also at the beginning, for all the participants, there is a chat box or a questions box. So in case you have any questions, just feel free to drop them in. We might be able to pick them up during the webinar or find some time at the end for a Q&A. But yes, so you told me before we can actually combine the scenarios. Now we've only added oil, right? So we've discussed copper, right? I feel copper is also a commodity often used by AI companies. So let's maybe add another scenario where we see the copper price go up.
Okay,
we have a couple of tech companies in there. So
let's create a new scenario, oil plus copper. So it's a commodity again, and we've got it here. And obviously copper, the expectation is because of data centers requires and energy requires for AI, right? So that we could have that go up as well. And okay, so now we've got an even bigger impact on the portfolio. Or do we actually? Let me just run the previous one. I know it's a smaller impact. Okay, so copper going up. What do we have here? So this mitigated some of the impact, and I'm trying to figure it out. So this is before. This is oil only. And we've got minus 13%. And then with oil and copper, we got a minus 8%. And you can see that the individual impact of Google and Amazon has reduced. So how to take this? What do we have in this portfolio? Amazon, Alphabet. So I think here, I mean, there is a play. I think copper these days is so tied up to AI that this can be a play here, that there is a correlation between copper and AI. And because Google, for instance, is massive on AI, you get a kickback at the back of that. So that could be one of the explaining factor here. So yeah, that's where we stand with this one. What I would do as well is probably try and kind of maybe, if I were David Smith, I would probably try and shed my position in Amazon at this point and replace it with something, a bit of an edge or something like that. Yeah.
So if I also on the left, I see there is scenarios I can play with if I would reduce a position. What if we would pick, let's say, another instrument that is more diversified?
Yeah, okay, so why don't we reduce this Amazon then? In that case, let's just sell today. So we're gonna sell Amazon, right? Sorry, yeah, here we go. So Amazon has been sold. So you can see our exposure to the United States has dropped, obviously. And then the exposure to consumer discretionary has dropped as well, quite significantly.
Aha, so what I'm seeing here is in gray what the going in position was, and then in blue that calculates the new position.
Yeah, blue is your new portfolio. So this is used to model portfolios. So this is how you start modeling it, and you can, obviously do that interactively with the client or just by yourself. I mean, obviously, a lot of the volatility comes from Google, but let's leave it for now. And what we could do is try and find an edge. So let me think, maybe a defense ETF. So let's just see if we have a defense ETF. This is a typical one, the VanEck. So let's add it as an instrument. And
so you can just look the ticker up and you find it immediately. That's quite impressive.
Yes, yeah. So that's we come equipped with all the data you will need. So it's like you don't need to think about having separate data contract or any such things.
How do you do this? Do you have one data provider, or because that's a major challenge, no?
No, yeah, it's a major challenge. It's the reason why we have a very unique business model in the industry. So basically, we have 15 data sources as opposed to maybe people just taking data from Reuters or Refinitiv these days or Bloomberg. We take our prices straight to the kind of brokers in a lot of instances. And that allows us to effectively be economically more viable than other companies. So we have a pricing which now makes sense for single family office or multi-family office where it's affordable in their context. And that's predominantly due to the way we process data. So we have 1.5 million instruments in the database, and this is increasing every day, basically, as we add data sources. But for most need, we're covered. And we also have partnerships with there's some esoteric funds. Specifically, we had a client in Denmark who had some really esoteric funds. We have partnership with specific companies to get this information as well.
Okay, impressive. Yeah, so hence the saying that you really allow for smaller firms to gain access to institutional grade analytics.
Yeah, exactly. And that's our main objective. We feel it's a market that is not addressed today. We feel there is a need, specifically, again, with AI coming up. You need an edge as a wealth manager, and analytics is an edge. Analytics are widely used in private banks. Just to give you an example, again, in Switzerland, probably 95% of the family offices, let's say we have a portfolio with 50% NVIDIA, 50% Tesla, 95% of family offices will tell you are 100% exposed to the US, right? Because they're just looking at reference data, which obviously is wrong.
Yes.
Because these companies are making more than 60% of their P&L outside of the US. So this is where factor modeling comes in to play. Private banks only work with factor modeling because that makes no sense to use reference data. But we need to bring that to the family offices. So yeah, back to our scenario, we got this defense ETF here. So what I can do is buy some of it. So we got 17 million. We don't want to over procure. Let's just buy. What's that? Let's just go 20,000 of it. For argument's sake, let's model with this kind of exposure. So let's see what we've got here. So where is my VanEck defense? It's only 2% of the portfolio. I'm obviously not very good with math. So let me just add a 0. That's better.
That sounds more like it.
All right. So it's okay. It's at the top now. So a bit strong, but we're gonna roll with it. So you've got it here. It's the new, obviously, your new kind of instrument there. And the main contribution is like this correlation to the industrial factor. So now we can go back to a kind of a hypothetical stress scenario and see if that kind of helped. Okay, so defense is still impacted, I suspect, probably with oil a little bit. Yeah, so that's where we stand with this one. Let me just see where oil is. Yeah, still impacted. Interesting. I didn't know defense was correlated to oil. I guess maybe it makes sense. I'm not sure.
Yeah, I mean, if you look at global supply chains, that doesn't surprise me to a certain extent, right?
Yeah, I mean, yeah, exactly. They're less price sensitive. Defense is less price sensitive than other because obviously it's government buying and they're buying because they're going to need. But for sure, I mean, everything is going to cost more, so their margin will go down. So yeah, that's probably what we're seeing here.
So what do you suggest? Should we add another scenario here?
Well, I mean, we can do that, or I mean, we have a number of modules here. So we talked about obviously the factor modeling, which is important. We talked about risk. So we have also historical stress testing. So what like this here, what you're gonna see is what will this portfolio how would this portfolio have behaved during COVID?
Yeah.
So let's just do a quick simulation so I can show you a little bit what this is all about. We'll let it cook. So in blue is this current portfolio that we have here. And in green is the same portfolio, but we've optimized for minimum risk. And that's, so we've rebalanced it for minimum risk. And it's called mean CVAR. And that's effectively, this is the most widely used way of rebalancing a portfolio. So we have a number of algorithms, but mean CVAR is used in all of the private banks because they want most of their clients want predictable income. So they don't want the dip here during COVID.
Yeah.
So that's kind of one type of balancing. Obviously, your overall performance generally is impacted by minimizing the risk. Yeah. And then in orange, we have a high volatility strategy. So it gives us a bit of a fork during COVID here and tells you where your portfolios sit between those two extremes in terms of balancing your portfolio. We have performance attribution. So here we can look at, for instance, in this portfolio, what do we have? What is interesting? Financial, consumer discretionary. Yeah. So consumer discretionary, your portfolio is, let's imagine it went up in that, I guess, 1 month period. So in the last month, let's imagine consumer discretionary went up and you were overweight. And that was a good idea. So your allocation was good. You went overweight, well done. But then if you look here, well, it's still up as well. Okay. So, and in terms of selection effect, though, your stocks that you've picked were way better than the benchmark, which in this case is the SMI. Mm-hmm. So you picked your consumer, which I assume is again Google, right? Or I guess let's just have a quick look what makes up the consumer discretionary here. Ah, no, you've got some Porsche automobile holding. Well, okay, so that outperformed the market.
Interestingly enough.
So yeah, so that's kind of the performance attribution analysis. Is those who know how this is useful. Then we obviously have automatic rebalancing with constraints, and then we have cash flow analysis as well. So that's where we are with this module within WealthArc.
Fantastic. Thank you so much. So let's maybe see if we also have some questions in the audience. Not as of now.
I mean, we're always available offline, right, for questions.
So we have a question coming up. Could you elaborate further on the methodology behind the stress testing?
Okay. So that's one for Raphael, this one.
Good, we have Raphael with us.
So here it's based on the covariance matrix. So how are the different risk factors correlated between each other for given different horizons? And what we do is, if you give us a scenario of 20% down for, or 20% up for oil and 20% up for copper, we reconstruct the most likely covariance structure given these scenarios, and then we can propagate these returns down to every single instrument. That's why when you go with sectors, for example, you have a plus 20% technology, then all the tech companies will be affected, but not only them, since we work with a correlation structure. Since tech goes up, the other sectors, or most other sectors, will also go up, and it will propagate to these instruments as well. That's how it works.
Yeah. So yesterday we did a scenario where we had oil and then oil plus consumer discretionary, and the delta between the two scenarios where the two were going bad, right? So oil was going up and consumer discretionary went down, and then just oil. And there was not that much difference between the two scenarios, simply because they are correlated, right? So oil going up leads to people not spending, right? So this is what we saw as well.
Yes, I remember that test, right? But that again then also proves that the methodology is strong, right? So those scenarios are not isolated; they're correlative, which seems logical, no?
Yeah, and look, I mean, our methodology is boring in the sense that it is used by all the private banks. So it's a well-established way of calculating, a hypothetical scenario. And you buy Bloomberg Port, you buy MSCI Wealth Manager. This is the same methodology. So in that sense, it's well anchored and people understand what it does. Yeah.
Okay, fantastic. Maybe now just quickly, assuming now that I'm preparing that conversation with my client, David Smith.
Oh, yeah.
I've done a couple of scenarios. So what would I do now? Probably I would want to report it. So
yeah, exactly. Look, we've done some really hard stuff, nonlinear combinatorial optimization, all of this, like really hard stuff. The thing people are more interested in is this button here, which PDF reporting, which is non-trivial technically, but from a mathematical standpoint is relatively easy. So yeah, I mean, you just press that button. At present, it's a kind of a single format report, but in the next week or so, we will have how do you call that? Customization to it. And hang on, where is it? There you go. So that's the report that or at least a number of our clients take to their client and say, hey, I've done the math, right? So you got your portfolio composition, factor exposure analysis, risk analytics, market independence. This portfolio is very correlated to the market. CVAR, so what's the worst case scenario, or 5% worst case scenario, expected annual return, annual volatility, all the stress testing we talked about. This is the efficient frontier, and then performance analysis. Obviously, it's a test. You call that portfolio? So there's some artifacts in there, and then all the kind of allocation selection effect to tell your client, hey, we have done better than the market, and this is why, or we have done worse, and this is why, and then cash flow forecast. So yeah, people use that. They say, we've done.
There's a cash flow forecast also.
Yeah, cash flow forecasting based on dividend, expected dividends, and fixed income coupon.
Okay, because that's a question I hear often when I speak to prospects and wealth managers in the market. Huh?
Yeah. No, we've added it based on client demand. Yeah.
Okay, fantastic. So if I get this right, this will definitely support me also on stress testing my portfolios. Hence, maybe also support me when I construct my portfolios, and essentially when I will have difficult conversations with clients, which I'm sure happen often, especially in such uncertain markets. It will also help me to gain more confidence and show more competence when reporting to the clients.
Yeah, it's a very psychological tool as well from a client's relationship perspective. Yeah.
Okay, fantastic. So I see we're slowly coming to a close. I don't see any additional questions in the chat or the question bar. Anybody has additional questions, feel free to drop them. Or what I'm doing right now is also I'm promoting a link here in case any of you would like to book a direct meeting with myself or speak with Cedric or Raphael directly, then please feel free to reach out to us. We can do any testing on your current portfolios. We can showcase it in WealthArc. So we're open for any sorts of requests. And maybe to bring it all together again, when you look at what WealthArc does, there is a challenge to bring a solid data foundation together in a multi-custodian setup. And this is our homework. We will obviously put a portfolio management system on top of that, which resembles a strong operational backbone for any independent wealth manager. Now, what we don't have as WealthArc is we don't have any advanced analytics because we also don't have the data. With this integration, information becomes more contextual. You can gain a deeper understanding, and that should, at the end, support the decision making.
Well, great. Thanks for having us, Dennis. Appreciate it.
Yes, and thank you so much for being with us, the two of you, and for showcasing this. It's now every week you guys come up with something new. It's really impressive. So I'm looking forward to our next session. And then to all our participants, thanks a lot for dialing in, and it was great having you with us.
Appreciate it. Have a great day, all.
Same to you. Thank you so much. Bye-bye.